A massive month of volatility behind us with Donald Trump's tariff wars not necessarily benefiting financial markets, but that volatility could continue into May or it could reverse. And that's where the movers and shakers show comes in. Let's look at the big movers within the indices, FX and commodity space to gauge exactly whether those big trends that are playing out towards the upside and the downside are set to continue or to reverse. So first and foremost, let's look at the big movers that have taken place throughout of the course of April when it comes to the indices space. And certainly it's been the index in India that has been leading the way. The Nifty up 5% over the course of the month. And it's been relatively wide split between the indices, quite frankly. You would think that considering what's happening in terms of the tariffs, that there'd be a more heavy focus on the losses. But as many of us in Europe will know, the DAX has been a big performer of late, but certainly it's been a couple of other regions that have really taken the crown, and the Nifty is one of them. Part of that is going to come down to the fact that the reciprocal tariffs ultimately got removed, and then we saw the focus really on the Chinese. And if you're to look for a country that potentially provides the move away from China and would benefit from the breakdown of relations between the US and China, it would be the Indian economy. And certainly traders have been looking elsewhere aside from US markets, and international markets have therefore started to look a little bit more attractive in certain areas. The German economy looking more attractive because we saw the reciprocal tariffs being removed. We also saw the imposition of a new rule around borrowing in Germany. We've seen the laying out of plans to ramp up spending, borrowing and spending in Germany and in the Eurozone as a whole on defense and infrastructure. So all of that plays into that theme within Germany. But certainly India also has another theme around it. And that's why that move into international stocks has benefited this index. On the flip side of it, that China story has led to the Hang Seng being a big underperformer. And certainly we've seen some very significant swings in terms of Chinese stocks of late. Remember, the Hang Seng is generally the international investors' way to get into China-related stocks. So generally, when the domestic investors get into or out of stocks, you would see it within the likes of the Shanghai or the Shenzhen composite. When it comes to international investors, generally they will make their views known through the likes of the Hang Seng. So people around the world have been moving away from certain areas and towards others. And the Chinese economy, the US economy, that's been out. Some of the other areas that have strengthened, the likes of India, the likes of South Africa, the likes of Germany and Spain, that has been benefiting as a result. So let's look at a couple of these charts to see exactly how this is playing out and try to gauge exactly whether these trends are going to continue or not. So first and foremost, we're going to look at the Nifty. Let's go into small mode, and we can see here, look at this weekly time frame, right? So what we've seen over the course of recent years has been a very clear-cut uptrend here. So the Indian economy really looking to benefit from this breakdown from this relationship with the US and China. And so the wider uptrend really has been sort of kicking in once again here. Comes against the backdrop of significant losses in the past. You can see here that we did see significant losses at the back end leading into these announcements, right? So certainly there had been some initial losses because we're talking about these reciprocal tariffs. We're talking about the onshoring, the nearshoring of manufacturing away from these manufacturing hubs in the world and into the US. Well, many have speculated that the low cost, low value manufacturing that takes place in the likes of India, the likes of China, isn't necessarily the kind of thing that the US should be doing anyway. So that does provide the basis for an agreement. And just yesterday, we did hear from Donald Trump, who said that they are close to an agreement and that talks are ongoing with India in particular. So India does stand to benefit from this potentially, and the potential breakdown with the US and China plays into their hands. Now, as we can see here, that downtrend that played out at the back end of last year leading into the tariff announcement, we saw that initial big gap lower. ultimately we've regained ground, and now this downtrend with the lower highs and lower lows has ended. You can see the rally up through your first swing high that is here, 23869. To me, well, it's been respected once again, but to me, this essentially is the bottom here. So I don't expect to clear out this 21743. So different ways of playing this. Ultimately, you can play this if you're looking for longs. You can play it for near-term sort of intraday movements, and you can see in which case you'd be looking at this swing low alongside that swing high of 23869 as a potential area that we need to stay above. Alternately, there is a chance that we do see the sort of recession fears re-emerge. Certainly if we see weak jobs data coming out and we don't see a breakthrough between US and China, and ultimately markets around the world just take a hit, right? Then we could quite easily take out that support level, but then we'll be looking at a retracement into this zone as a potential bottom for this market, as it gives us a little bit more time for things to sort of play out and get resolved. But certainly the basis is here for us to have bottomed out here for the Nifty, and I wouldn't be surprised to see this long-term uptrend continue apace going forward. Then, like I said, the flip side of it has been the Hang Seng, and we've seen very sharp declines. Here's the daily time frame. So you can see that April saw really dramatic declines. And we have been trying to regain ground since then. So it's certainly not as bad as it could have been, right? Certainly at the beginning of it, from the beginning of the month, you were down like 18%, 19%. But we've been regaining ground since then. In actual fact, if you look at the weekly time frame, you can see that this market actually looks to be picking up a little bit. Certainly, the Chinese are looking to enact new stimulus. The US certainly appear to be making overtures to be able to start trade agreements with the Chinese. So there is the potential for good news to come in the near term. Quite whether that's going to be good enough to be able to actually completely fix this relationship, that remains to be seen, because Trump was talking about potentially bringing that tariffs back down to 50%. That's still massive, right? I know that it's a lot lower than 145, but it's still very high and still has very significant implications. Nonetheless, there are a few levers that the Chinese have pulled when it comes to rare earth minerals and the like. And so they do provide the basis for them to be able to get a decent trade deal with the US. It might be a little bit of a protracted one, but the US clearly wants to get something done over the near term. So we have been regaining ground. I personally think there's a good chance we sort of continue on this vein. And so just look out for these swing lows, right? So this is a very clear basing area where we pushed on to the next level. We've consolidated since then. As long as we remain above the 208.31, I think there's a good chance that we do continue this and start to move higher once again. Perversely, if we see weakness in terms of the sort of US data, whilst you could see sort of risk off around the world, that might provide the basis for outperformance in China, because that could be the kind of thing that pushes Donald Trump to come to the table and enact talks with the Chinese. So an interesting one to follow. One way to sort of look at that would be, saying what happened around that ADP release. We did see some weakness coming with that weak ADP number, ultimately regaining that ground quite swiftly and remaining within this consolidation mode. So for me, yes, we've seen sharp selling, but we've recovered quite a bit of that. And I think considering this sort of basing pattern here, I wouldn't be surprised to see this mark the bottom, and that soon enough we potentially see some possible breakthroughs between the US and China. There's still question marks about the direction of travel for the economy, but the Chinese government and the PBOC do appear to be more willing to step forward and enact more significant stimulus in a bid to overcome some of the troubles faced due to the tariffs enacted by Donald Trump. Next, let's look at the FX space. And this is all about havens, right? So when we've got weakness for global markets, a lot of fears around the world, what are we looking for? Well, we're looking for havens. And the US dollar has not been that. It's the underperformer since Donald Trump's taken power. And so the question mark is, where do we look? And you can see here the two other havens that people commonly use are the Swiss franc and the Japanese yen. And those are the two at the top of the stack, right? 7% move over the course of a month, absolutely massive. So we've seen some really big moves for some of these FX markets over the course of April in particular, driven primarily by the fact that people are seeing such significant weakness for the US dollar. So let's look at dollar Swissy and see quite whether that trend is going to continue or whether we're going to start having to look for a potential reversal. This is the monthly time frame. And I think this is really notable. First and foremost, we're very accustomed to a downtrend here, and it's a continuation of that with a break lower, taking us into the lowest levels we've seen since 2011. But as an argument, it's relatively overstretched at the moment. You can see that each time we're coming into these sort of areas around the sort of trendline support, we then move into a multi-month phase of retracement within that downtrend. Now, will we see that coming into the fore now? I think a lot of it comes down to this idea of like US exceptionalism is over, and therefore, even at times when we need a haven, the US isn't a haven right now. Well, that might not necessarily stand forevermore, and part of it's going to come down to whether we start to see trade deals coming across the line and those broken relationships beginning to fix. And so let's look out to see if we can continue. Let's just get this here. So let's try and see if we can recover some of this, because you can see quite clearly over the 4-hour chart that we're starting to now create higher highs, potential for higher lows. So if we break up through your near-term swing high here, 0.833, then, you know, maybe we could start to move into a period where we claw back some of those losses. But notably, Donald Trump in his first year in power last time around, we saw widespread selling pressure for the US dollar, and he certainly will see US dollar weakness as a potential tool to win in the US trade war when it comes to tightening some of those trade deficits and the like. Of course, it makes their goods more competitive abroad. So you won't necessarily mind a weak US dollar, but there is a chance that given this sharp decline seen over the course of the month, that maybe this has run a little bit far for the time being, and we could see some of that taken back. It's a bit of a breather within that trend. In terms of the final area we're going to be looking at, that is the commodity space. And we can see here gold at the top of the pack, at the bottom, Brent Crude very closely behind that, nat gas. But ultimately, it is a story around havens where the US dollar isn't that, and we've talked about that, and the story around demand destruction in the face of fears around a potential recession. So let's look at it one by one. So gold has been very much in favor over recent years, and in part that is led by OPEC members, where essentially they don't necessarily, BRICS members, they don't necessarily want to follow the world order that is based around everything having, you know, all transactions having to take place in US dollars for commodities and the like. You know, they want to change the way that the world is operating away from the US. And right now, considering the ramping up in terms of debt over in the US, considering how the US has proven itself to be an unreliable trade partner, doesn't necessarily point towards a need to start investing in US treasuries right now, especially when the US is enacting a trade war in pretty much every country around the world, even islands full of penguins. So that points towards people moving towards gold once again. Alongside that, we've seen stockpiling over in the US taking place as well. So even in the US, they're moving towards gold. Now, how long is that going to last for? That remains to be seen. And certainly tariffs have played into that narrative about the idea that everyone wants to move away from the US. And if we do see trade agreements, then it could, you know, if we're seeing risk on and we're seeing trade agreements come into pass, then we can see some of the heat taken out of gold after a blockbuster period of strength. So let's look at the chart, and then we can start talking about Brent Crude. So here is the chart. Let's go full screen. So here's the chart for gold. Oh, there it is. And we can see here, this is the monthly time frame. So we've sort of seen this absolute exuberance popping up into sort of almost, yeah, so 3,500 we saw as the top here for gold. And we saw that sharp decline in the back end of the month. And we've started this new month with a similarly strong move towards the downside. So a big day of selling taking hold here on the 1st of May, quite frankly. And like I said, a lot of this is likely to be in line with the idea that, like, you know, maybe trade deals are in the offing. The US are approaching China to start trade negotiations, things like that. I don't necessarily think that plays into the gold, bullish gold narrative per se. At the same time, there are certainly things that do point towards further upside to come down the line. In part, the idea that we're going to see 100 to 125 basis points worth of cuts from the Fed this year. That's what markets are currently pricing. That's the kind of thing that's good for gold, right? We're seeing US dollar devaluation. That should be good for gold. But now we're starting to see the US dollar sort of regaining a little bit of ground. So maybe that breather phase also points towards a breather phase for the likes of gold. Let's just put dollar index over it and see what that correlation is looking like at the moment. Here we go. So let's just invert the dollar index. There we go. So essentially, as you're seeing the potential for a sort of rebound phase for the US dollar. So you're starting to see gold coming off. So again, weakness for the US dollar should play into further upside for gold. If we see a bit of a pop for the greenback, then it's providing the basis for a potential pullback here for gold. Nonetheless, we're still within a very clear uptrend. I mean, look on the monthly time frame. This is a very strong market, right? And you don't necessarily know how long these bull markets are going to run for, but we're still in the middle of a phase of easing from central banks, and that is generally beneficial for gold. And so I wouldn't necessarily expect this trend to be over, but we are in a retracement phase in my mind. So look out for trendline support and look out for Fibonacci support. So the next fib in line would be 31.63, which is 61.8, and then below that the 76.4, which is at 30.84. Potential move back towards the 3,000 mark. Now, it wasn't very long ago, certainly around about a month, that we were talking about, wow, we've broken through the 3,000 mark. Well, even if we do see a sharp pullback, we're still just coming back down towards levels that are above that 3,000 mark. And that exuberance where we're seeing $100 a day added, where we're seeing that reversed at the moment. So I see this as a retracement phase set within a bullish trend. And I do think that by and large, whether it's the fibs, whether it's the trend lines, we'll soon enough likely see the bulls come back into play in a bit of stabilization and then likely turning upwards once again. But keep an eye out for those trade negotiations nonetheless. And finally, oil prices collapsing over the course of this week, roughly down 10%. This comes from a number of different things. One of those things was the weak data coming out of the US, the GDP coming in at minus 0.3, the ADP number coming in well below expectations. We've also heard from Saudi Arabia, who essentially are saying that we're done supporting the market. We've got the likes of Iraq and Kazakhstan that are overproducing compared to their quotas. We've, of course, got probably an agreement with the US where Donald Trump's putting pressure on them to stop pushing prices higher because he wants to be able to enact everything he wants to enact. He doesn't want inflation to rear its head once again. And the one way that he appears to be targeting keeping inflation low is through energy prices. So driving down oil prices is all part of that drill baby drill move, right? So drill baby drill isn't great for the drillers themselves. And actually the potential for increased production in OPEC points towards lower prices and potentially the cuts in terms of production coming from the US because they're no longer viable, economically viable to carry on drilling. This is the sort of long-term, the monthly time frame you can see coming down to levels not seen since March 2021. Where do we go from here? Well, it's quite uncertain, but what we can say for certain is that there's a very clear-cut bearish trend at the moment, and this latest retracement has given way to another steep leg lower. So look out for your near-term support level at the 58.44 mark and just follow this on a sort of intraday basis, right? It's very sort of clear cut at the moment in terms of this trend. So we're seeing these sort of moderate retracements and then rolling over, and then near-term rallies are sort of very short-term in nature before we see the bears coming back into play. And we need to start seeing a push up through some of your sort of swing highs to start saying anything other than that this looks bearish. And so 61.28, 62.95, until we start breaking through those levels, near-term upside looks like it's probably going to be treated in much the same manner as the rest of this past week or so. So the bears well and truly in charge at the moment. And certainly Saudi Arabia appear to be in a position where they're not interested in supporting it and saying that they can withstand low prices for a long period of time. So low prices could be here to stay. That is good for disinflation. And hopefully that points towards a possibility of further rate cuts from central banks. And that points towards a possibility of gold coming back up once again, despite the short-term weakness that we're seeing at the beginning of this new month. I hope this has all been useful. Follow us for more content like this. Like, subscribe. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Thanks a lot.